Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
And going back, if you look at this in this prior slide, the products that ISE offers, you have two choices. Remember, in the euro currency, you now have a euro currency based in euro currencies versus the U.S. dollar index, as well as a U.S. dollar versus euro currency index, the EUI. So in that case, it could be slightly confusing, but you got two ways to play this. If the U.S. dollar is suspected to go up, then you would want to be a buyer of puts on the EUU, and you would be looking for the euro currency to move down against the U.S. dollar. And the opposite is true for the EUI. And if that's the case, you do have the opportunity, if it presents itself, to do what? Do the opposite. Sell puts in the EUI. And there you could collect premium as the market moves in your favor. So there are two different ways to play the option strategies. There's, as they say in the trading world, there's 10 different ways to skin a cat. There's different ways that you can play the market, and with the ISE's products, they allow you two different types of strategies for almost the same type of play, and it depends on your risk tolerance, and also it depends on your understanding of options, but they have the product there, and we have the scenario in play right now, because, folks, this is the scenario I just gave is what really is at stake right now. The FOMC here, and I'm sure a few of you do recall the FOMC minutes of their last meeting where they talked about they did not raise interest rates, right? It wasn't at the minutes of the last meeting. It was the Fed announcement. They did not raise interest rates. But they cited the economy's doing well. And all of a sudden, people started scratching their heads. Well, if the economy's doing well, why are interest rates still at zero? Shouldn't you start to tighten? Or is there something there that the Fed sees that no one else knows about? And perhaps that's why it kind of stunted the move in the U.S. equity markets, and we really haven't seen a tremendous move in the U.S. dollar until just this week. We also are at a very important turning point right now, which is we're at the end of the quarter. Folks, not many fund managers are going to risk their entire month's work or their entire quarter's work in the next 2 trading days. Many people, if they've had a really rough go this quarter, they're just sitting on the sidelines and they're just going to get back in the game starting in the fourth quarter, which begins when? Thursday. So there's a lot going on in the marketplace, and I think it's great that the ISEs allowed me to come in and give this presentation, because it's a very timely situation, because it's not just that we're coming into the October earnings season, but it's also the fourth quarter, man. It is like, third and long right now. What is going on? And if the economy is turning around, guess what? Interest rates go up. That's going to be supportive to the U.S. dollar, as long as interest rates are going up in a favorable economic environment, or at least if the Fed is starting, if they talk about tightening. Not that they necessarily would, just talk about it. So if there's more talk about the Fed's exit strategy, that would be dollar supportive. Other than that, I can't see anything else out there that would be dollar supportive right now. But there are, if you're armed with this information, if you're armed with the ramifications of what central bankers' actions can do, armed with that information, now you have a little bit of education in how to take advantage of those potential moves, at least from a calculated risk-reward standpoint. And that's what's important, that there is a product out there. There are options. It's optionable, obviously. It's what it is. These indexes are optionable. And you have the availability to take advantage of maybe not just day trading, which you could be right and still lose money, but you have advantage of taking a market potential move that could last anywhere from 90 days to 18 months. So using options is a great way of participating in this so-called eventual move that we're going to see. Either the economies are going to improve or we're going to be status quo, and either way, you want to maybe take a look at some of these products. Now, I talked about pivot point analysis, and just to go over, and this is not a session on complete session on pivot points, but just so that you understand that pivot points are a mathematical model. It's one of the tools that I rely on and use very heavily, and I use daily, weekly, and monthly time frames. What you and I just saw on a chart was a monthly time frame. And so what's really neat is at the end of this month, which concludes tomorrow, I'm going to take the currencies high, low, the range for the entire month of September, and the close, and then we're going to be able to calculate and see what the potential A condition for next month is, number one, and number two, look at what the potential high and low or predicted range will be. So if you're not familiar, this slide, I'm going to rattle off what the math formulas are so that you can see that there really is a math formula. The pivot point is what we call typical price, is derived by taking the high, low, and close divided by 3. Then there are 2 resistance targets and 2 support targets. And we'll get to this, and I'll talk about refining and filtering out these support and resistance numbers in just a few slides. The first target resistance is calculated by taking the calculated pivot point value times 2, then subtract out the low. Then, to get the second target of resistance, we take the pivot point, add the high, then subtract back out the low. Then, to get the first support target, you take the pivot times 2, subtract the high. And for S2, or the second support number, we take the pivot minus the high, add back in the low. So it's a detailed formula. Thank God for computers, because we really did used to do this by hand, or I did, back some 30 years ago. Now, there are some people out there, there are other educators, who have come up with a third resistance and a third support. And in my research and analysis, I don't use them. And they also have these midpoint numbers. And I just find if you have all these numbers and lines across your screen, I absolutely find them to be burdensome and without a doubt confusing. I mean, if you think about it, we would have 13 levels on your chart every day, week, month. In fact, if this was a daily chart and these were just daily numbers, you would have 13. Let's count them up. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. That's 13 dailies, 13 weeklies, and 13 monthlies. Folks, can you imagine having all those lines on your screen? And that's why I say burdensome. There's just no way it would be effective. I would not be an effective trader.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.